Welcome to Retirement Unlocked with Larry Heller. Your life, your way, unlimited possibilities. Join us as we explore how tailored financial planning and investments can help you navigate life transitions with confidence. Let's dive into this week's episode.
Welcome back to Retirement Unlocked with Larry Heller. Losing a spouse is emotionally overwhelming, and many surviving spouses are surprised to learn that it can also create financial and tax consequences. In this episode of Retirement Unlocked, Larry discusses the often overlooked widower tax penalty, why taxes can increase dramatically after the loss of a spouse, and the key planning strategies that surviving spouses should consider to protect their retirement income, Medicare premiums, investment, and estate plans. This episode focuses on proactive planning, helping couples and surviving spouses avoid the costly mistake during one of life's most difficult transitions. And it is a difficult transition, Larry. This is a tough one, and a lot of people probably would just as soon not have this conversation. But as you're about to make really clear, it's important that you start now.
Yes, when I say now, it's before one of the spouses passes away.
Yes.
So, because a lot of retirees assume that taxes will go down after one spouse passes away. But in reality, tax brackets become less favorable. Your income may remain relatively high. Your deductions may decrease. Your Medicare premiums could rise. Your investment and estate decisions kind of now fall on one person. Mm-hmm. So the surviving spouse can end up paying significantly more taxes on the same or even lower income. Whether you call it a single penalty or if you're married, that you get a little bit of discount, but the brackets start at a much lower threshold when you're single than when you are married.
Well, yeah, because I think a lot of retirees assume that taxes will go down after one spouse passes away. But apparently this widower tax penalty is a real bear waiting in the woods for people.
Yeah. So, I mean, after one spouse passes away, your Social Security could go down because you'll lose one of the Social Securities. You'll end up with a higher amount. But other than that, your income may stay the same because the same investments, most of the money, if it's going to the surviving spouse, the income is going to stay the same unless maybe you had a pension and so forth. So the higher taxes could apply even at much lower income levels, as your status will change from married filing jointly to single, and the tax brackets are compressed substantially for single versus married.
Yeah, and I think a lot of people don't think about that. They think, well, they've been married filing jointly for so long, they don't remember that individuals actually go into a different tax bracket entirely, and those rates will increase. And I guess that's part of what amounts to this widow tax penalty that you're talking about.
Yeah, and there's some other things that your IRMA taxes, your IRMA premiums could go up. What I mean by that is, well, when you're retired and you're on Medicare, so you have to pay a premium that could go up. We'll talk a little bit more about that. Your standard deductions maybe will be higher when you're married versus when you're single. Possibility, better capital gain thresholds. So there's a few different things that the married couples will benefit that when there's only one spouse, they're going to get either penalized or they're going to have to pay more. So when the year of the death, just to be clear, and the year that you die, you can still file married filing jointly, but after that, you're usually filing single.
Mm-hmm. Talk about the retirement accounts problem that exists for couples, because I would assume most couples come into you and, they've got a couple of different sources of income that are coming into them, and both from different spouses.
Yeah. So IRAs and 401k plans, when you're both alive and you eventually have to take a required minimum distribution, you have to pay income on that. So And now with the requirement distribution being pushed back to age 75, if you're born in 1960 or later, if you're born before that, to age 73, you may have a long time before you're taking money out of these retirement accounts. And the balance, especially if you've done well in the market, could have substantially increased. So now when you have to take requirement distributions out, it's at a much higher number. And if you're looking at it when you're married and both spouses are alive, you're going to pay less taxes than if one's single. So you're withdrawing the same amount of, assuming both spouses are the same age. One dies, the other, that gets rolled over to the surviving spouse. And now when that surviving spouse hits the requirement distribution age, they're taking out the same amount as when they were married, but they're taxed higher on it. It may not seem fair, but that's just the way that it is.
Wow, that is tough. So what about some of the opportunities or planning opportunities before you've lost your spouse in here? Is there Roth conversions on the table, or what are we looking at?
Absolutely. So now you want to kind of look at when you're first retired and maybe not taking Social Security, what tax bracket you are now, and then do some planning on seeing what tax bracket you could be in when you're taking required minimum distributions. And if there's especially if there's a big difference in age between one spouse and the other, the younger spouse may have more time, longer times to accumulate money in their retirement accounts. So they may be in a higher tax bracket because they're possibly could be a widowed at that particular time. So looking at the Roth conversions now versus the Roth your income now with Roth conversions versus your taxable income later on, just one thing to look at and see if it makes sense. It also may make sense to do some partial withdrawals from your retirement accounts while both spouses are alive, because you're getting to use the more favorable joint tax bracket. So there are planning opportunities before a widowhood that you kind of want to take a look at, and possibly don't lose them. We've had people that have come in and they're now at the requirement distribution, but for the last 5 or 6 years they've been in such a low tax bracket, but no one's ever said to them, well, take a little bit out, pay a little bit in taxes now to prevent paying a lot more in taxes later on.
Oh yeah, and would it make sense maybe in some cases, depending on the people involved, that in addition to the required minimum distribution, maybe they take a little bit extra on top of that? Is that kind of what you're talking about?
Yeah, that's what maybe not on top of it, maybe instead of, or a combination of both. So really looking at the brackets, maybe you fill up your 12% bracket now. When you're married, you can put more away because that limit on the 12% bracket is higher when you're married than when you are single. And looking at a possible bracket, you could be in 24 or 30 percent bracket later on, because your required minimum distributions kick you into a much higher bracket later on. So does it make sense to take some out at 12% versus paying at 24, 30, or 30? Again, every situation is unique, so you have to look at it and see what makes sense. And we run a lot of these numbers and a lot of these strategies and a lot of these game plans to see if it makes sense to do Roth conversion or take some money out of the IRA at a lower bracket. Well, one, you're married, but by two, you're in a lower tax bracket.
You mentioned an acronym that has become my least favorite acronym, IRMA. and we did two episodes ago. We did you did an excellent explainer podcast talking about IRMA, what it is and the impact that it has. But, talk about it in this kind of situation, in this particular case.
Yeah. So IRMA is the income related monthly adjustment amount that you have to pay on your Medicare premiums. So if you're paying your Medicare premiums, now I think it's somewhere around $200 and $90 for, I don't know what it is for the Medicare Part D, but your Medicare Part B and your Medicare, which is your hospitalization, your Medicare Part D premiums for your drugs, is based upon your income.
Mhm.
And a lot of people don't realize this. So if you're married, it's based upon your married number limits. So just like your tax brackets, your IRMA limits are higher when you're married than you are when you're single. So if you pass away, and you're paying Medicare, the amount that you have to pay for Medicare may increase, even though your income has stayed the same, because now it's based upon a single filer, which is much lower than a married couple. So your income could go down, your taxes could go up, and now your Medicare premiums could go up. So you want to take a look at that. Not that there's much you can do about this. Watch episode 199. There's a couple of things we talk about in there. So your requirement distributions can affect your IRMA. One-time income events can affect IRMA. Capital gains, Roth conversion timing. So a lot of things you want to kind of do that. And no matter what, and I don't care how much money people have, they loathe paying higher IRMA amounts.
Oh yeah.
Sometimes we're making investment decisions and we're saying, well, you gotta make some diversifications decisions, and it's going to be higher in taxes. And yes, it may increase your IRMA, but we need to do it from the investment standpoint. And from the tax standpoint, they kind of get it, but they hate doing the IRMA. And the last thing you want to do is not to explain that to a client up front, because if they don't realize this, we've had clients come to us because their previous advisor never talked to them about that. And they were so upset that their IRMA premiums went up, they want to switch their financial advisor. So knowing what that is, and knowing that could, that could go up later on.
Yeah. It's not Larry's fault, everybody. It's the government. They always want their money, and they always want more of it, it feels like. What about Social Security? How's that impacted when a spouse passes away?
Yeah. So again, when one spouse passes away, you're going to lose one of the Social Securities. The survivor gets to keep the larger of the two benefits. So again, your Social Security could go down, your taxes could go up, your Medicare premiums could go up. So there's kind of three things that the government's hitting you with: tax penalty for being a widow, penalty for higher Medicare premiums if you're a widow. Some people want to look at it that you get kind of a discount if you're married, but so the Social Security, your income could go down that you're receiving for Social Security, but maybe your taxes will go up. So planning about that, coordinating that, looking at the survivor benefits, looking at your retirement plan. If one person would pass away, to see if it would have an impact is very important.
What about estate and planning issues, Larry?
Yeah. So when a lot of times when we're looking at this, there's a lot of different documents that you need to be aware of: power of attorney, healthcare proxies, trusts, whether you have a revocable, irrevocable trust, your wills, your beneficiary designations, your asset titling. All those things come into play when one spouse dies. Well, they will, but it'll be a lot easier if you've discussed this and you went over these documents while both spouses were alive. A lot of times where we see that one spouse, typically the man, handles everything.
Yeah.
It doesn't even get the wife involved. And then when the husband passes away, the wife is just overwhelmed with everything that has to get done, especially in an emotional time frame. So the more that you can discuss, the more that you can plan, the easier it will be for that surviving spouse.
What about beneficiaries? I know that it's like I occasionally go review my beneficiaries to make sure that they're sort of, updated and still accurate. Do you find that you need to encourage people to do that?
Yeah, there's really two things that we want to take a look at. We want to take a look at the beneficiaries, and we've seen ex-spouses named as beneficiaries. We've seen missing children. We've seen minor children named as beneficiary. All things that you don't want to have happen.
Yeah.
And after one person dies, it's kind of too late. It's already been named there. So you want to, like you said, you want to review the beneficiaries every so often, making sure that they are still the way that you want it to be handled. And then also asset titling. We've seen these revocable trusts set up, and then a lot of times the assets weren't changed in title to the revocable trust, so nothing goes through them. So, making sure that this is done, organizing them, updating your estate documents, simplifying all these decisions while both spouses are alive. I mean, one of the things that we do, one of the benefits is really getting everything into a computerized vault where everything is there. Both spouses know exactly where it is. And if one passes away, the other one can really have a clear understanding. And if both passes away, we can then turn this on to the executor. A lot of times the children of there, but waiting and not having a spouse really understand what's going on can be totally overwhelming, not only from an emotional standpoint, but in a financial standpoint. And one other thing for those of you in New York State, that the New York State estate tax, without going through this, is not portable. What do I mean by that? Well, while we speak, the estate exemption is $7.35 million. So if you do proper planning, you can protect $14 million. But if you don't do it before the first spouse passes away, you can lose $7 million of exemption. In other words, if all the money was in one spouse's name and the other spouse's dies, there's not a portability, so you can't protect $14 million. So really making sure how the assets are titled properly in New York State can be significant, especially because they have what's called the cliff tax, which could be taxed from $1. That could be a whole nother podcast, but really making sure that that's done properly.
Well, that point makes a really obvious point, which is simply you need to plan. You need to be doing this planning before the crisis moment happens.
Yeah, absolutely. You want to talk about the tax strategy. You want to talk about where the assets are held, what the income sources are, their estate wishes, healthcare decisions, all things that you want to do ahead of time. So when you're going through this traumatic time in your life, that you've already had all these conversations. Yeah. And then you also want to talk about kind of what happens, some of the planning things. Should we do Roth conversions now? What happens to the income if one survives? Will their survivor have enough cash flow? Running retirement planning and showing how taxes could change. Like we mentioned, updating the beneficiary designation and really having that surviving spouse knowing where everything is. And we're pretty adamant, that we want to have both spouses here, even if the one spouse doesn't really want to really know the minutia of the financials and the finances. Just knowing that they have an advisor here that can kind of hold their hand at a critical time to guide them through all these decisions.
Can you give us a couple of real life scenarios, Larry, that you've encountered in your practice that will help people to understand why this is so important?
Yeah, we've talked about it kind of, a little bit in generality, but we've had people, one spouse passes away and they've had a couple $1 million in IRAs. They had a pension, which now is going to be half because they had joint with survivor at 50%. They had 2 Social Security checks. So now what happens? One spouse, maybe a lot of times the husband, because men pass away earlier typically. Yeah. They're going to have RMDs. And again, the required minimum distribution could be at a higher tax bracket, like we talked about. Social Security, one of it goes away. The surviving spouse is going to file as a single. Medicare premiums are going to rise due to IRMA. So planning on this and really kind of doing some things ahead of time. So, to minimize possibly the taxes that are going to be paid by doing some of the strategies such as Roth conversions or partial IRA withdrawals and some tax bracket management.
Yeah, well, it's a really emotional, disturbing time for most people when they lose a spouse. And, I would imagine it becomes even worse when you come in and you're a spouse who's, not really used to making the financial decisions. And this could all be a little overwhelming, I could see.
Yeah, absolutely. Listen, we've had a couple years ago, we had a client, and the husband died in his sleep overnight unexpectedly, and obviously it was a very emotional time for the wife. She wasn't home at the time, and when she came in, and she always came in for the meetings, but she didn't really understand everything. And basically, our husband said, everything's here in one place. You have Larry and his team, and they'll walk you through everything. And we did, and we got her through that. And for us, it was extremely rewarding when she said, you know what, without you guys, I just wouldn't have had the same peace of mind going through this at such an emotional time. So that's, very rewarding to us and what we do and how we can help.
All right, Larry, as we get to the end of this episode, why don't you wrap this up and put a bow on it for us?
Yeah. So just to summarize, the loss of a spouse can create unexpected increases in taxes. The single surviving tax brackets are less favorable. The IRMA thresholds that you pay on your Medicare costs could go up. The larger retirement accounts, or the same retirement accounts, but now could cause higher tax burdens later on. Planning to make sure that you do possibly Roth conversions or proactive tax planning, and making sure all your estate and beneficiary reviews are done while you're both alive and get them in order are critical. So preparing before a crisis can tremendously reduce stress and save money in costly mistakes.
Absolutely. And that is the single best argument that anyone could possibly make for coming in and sitting down with you now and having the conversation, Larry. And listeners, thank you for listening to Retirement Unlocked. If today's episode helped you better understand the financial and tax challenges surviving spouses can face, please like, subscribe, and share this episode with someone who you think may benefit from this conversation. And if you'd like help reviewing your retirement income strategy, tax planning opportunities, estate plan, or survivor planning considerations, consider a complimentary 20-minute call with our team. And I've noted it before, but I'm going to tell you again. Remember, Heller Wealth Management is now a part of Savant Wealth Management. Savant is a registered investment advisor. This content is provided for informational and educational purposes only, and should not be construed as personal investment advice. Thanks for listening.